talking about some of the frustrations that you and I and sort of the rest of the folks that have investments out there feel on a regular basis. It's always amazing, even after doing this for 25 years, just how quickly sentiment and the markets can really change. And it almost seems like we've sort of seen that over the course of the past 30 days, where the media, almost like has gone from this story about the recession is coming into making it probably one of the most widely anticipated recessions ever expected, to the question that you're hearing sort of a growing thought on is, well, did it already come? And we just missed it because last year, being a political year, nobody wanted to deal with the R word, but first quarter, second quarter of last year, negative economic growth as measured by the GDP, that certainly would check the box, if you will, on the technical definition of what a recession is. So, and it underscores sort of the cost, right? The cost of getting hung up in this headlines that change nearly every week, easy to get whipsawed. And as we were saying before the break, a lot of studies say that then causes people to make investment decisions and ultimately winds up, because those investment decisions aren't terribly consistent when you're sort of making decisions in reaction to the headlines, whatever they may be, because they change again tomorrow. As a result of that, you wind up not achieving the kind of return that you should be achieving over time. And that basically translates to the fact that you have less money in retirement. So that's certainly not a good thing. And so we wanted to kind of look at some of the stuff that has been happening over the course of the past couple of weeks. And one of the headlines that you may have seen is that the stock market this past week, and even sort of the week before as well, kicked off a new bull market. So let's pause there for just a second, sort of talk about sort of what all of this means in technical investment type language, if you will, just to kind of make it make sense. So here's the definition. So when the market declines by 20% or more from sort of a peak, then that puts the market into what is known as bear market territory, right? And so in order to kind of escape that bear market territory, the market then has to reverse itself by 20% over the course or from that bear market low. So if you think about the markets, they go down 20%, okay, boom, we're now in a bear market. If the market subsequently go up 20%, then okay, great, we're in a bull market. And here's the thing, every bear market has been followed by a bull market. Every bull market has been followed by a bear market. Every bear market followed by, you get the trend. So that's the cycle. The really good news, though, that you have to remember as an investor is that bull markets last much, much longer and produce a much greater positive result than the bear market. So to exit a bear market and start a new bull, then there has to be sort of a rise by the markets of 20% from sort of that low point. And so obviously early last year in 2022, markets have declined by a cumulative amount of 20%, shifting the market out of the bull that had run in 2021 over to a bear market for the year 2022. Well, along comes, kind of the end of the year and the year 2023, and what's happened over the course of the past 8 months is that, lo and behold, you have a market that has increased by 20%, thereby flipping the bear to a bull. So that's the sort of the technical investment language stuff behind the headlines. And certainly that's pretty exciting stuff, right? I mean, better to be in a bull market than a bear market, right? And bull markets is better for your money than a bear market. So that's good. But we got some interesting data that we want to share with you that goes hand in hand with this bull market, the bull is back kind of conversation and headlines that we've seen over the course of the past couple of weeks. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on our website at nelsonfinancialplanning.com. And if you've got any questions, or if you've got a topic that you would like us to talk about on the program, well, that's how you can reach us and say, hey, Joel, I want to hear about ABC, or I want your opinion on DEF, whatever the case may be. That's how you can reach us and become an active participant in the program itself. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries. They stand ready this week to help you change your life with a successful and cost-effective financial plan. So what are some of the exciting sort of statistics behind this flip from bear market to bull market that has happened over the course of the past 2 weeks? And certainly history has seen a lot of these changes, because that's sort of the cycle, right? A bear market is always followed by a bull market is always followed by a bear, and you get the picture. So one of the things that is interesting is the data in terms of frame of reference for how long this bear market that we saw in 2021 and started in the end of 2021 and then into the beginning of 2023, is actually the longest bear market in 75 years. Lasted for a total of 248 trading days without having that requisite 20% plus recovery to flip it out of bear and into bull. So it certainly had run a long time, and the interesting stat is it was the longest in 75 years. That says a lot about how much, I guess, pain as investors that you may have been feeling, how much concern, how much worry, because there wasn't that reversal that you typically would expect, and it has always happened in sort of a shorter time period. This one took a while, and in fact was the longest in 75 years. So, but that has finally happened. Again, bear markets lead to bull markets. It's a pretty consistent track record. But here's the interesting data. And so hold on to your hats for this one. Don't be careful. I don't want you to get too excited about what we're next going to say, okay? Because I think it's way too early to call all clear and it's all sunshine and roses and all that kind of stuff. And we don't really follow that process anyway, because we think it's more important to be consistent, to not get too caught up in whatever's going on any particular day, month, quarter, year, or what have you. But here's the suggestion that history has for us. There may be continued opportunities ahead. Traditionally, markets keep rising after kicking off a bull market. Since 1950, if you look at those recoveries, those bears turning to bulls, the S&P 500 rose 92% of the time over the course of the next 12 months after that flip from bear to bull happened. Pretty interesting. The average, 19%. Stop and listen to that. That's a pretty good number, right? What would an extra 19% on your investment portfolio look like over the course of the next 12 months? Sounds good, right? What does it take? Well, it takes not getting hung up in the sentiment of the day, where that's going to throw you off because you're going to overreact to some headline, and maybe you already did. Maybe you missed the last period of time where there was a run up on the course of the market. Obviously, if you go from a bear market to a bull, and then it's like a 20% rise. Maybe you missed that already. Maybe you're like halfway behind, but we would say, well, you don't want to continue to fall behind. The strategy of getting in when you feel like it and getting out when you feel like it is no way to ultimately achieve long-term investment results. So certainly some interesting stats, some interesting historical numbers. Again, probably too early to call all clear, but some interesting data that has happened over the course of the past week, just this past week, right? We saw the inflation data at 4%, down from 4.9% from the prior month. certainly half or less than half of what it peaked at last year at 9.1%. And then the Federal Reserve saying, hey, we're going to, pause and see how all of these prior interest rate increases play out. So some interesting stuff there in terms of kind of how all of that plays out. Here's the call to action, if you will. Might be good to check out your investment mix and your investment portfolio to make sure that, hey, am I really participating as well as I should be if the market is going up? I certainly want to be able to be participating in that upswing in the market. So make sure you take a moment and really double check what your investment portfolio and your investment allocation looks like, particularly in times like this. With that, we'll take a break and continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning.